Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. Trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob.
Yeah, hi, Jim, and it's Friday in the markets.
Bob, like we always like to do, we have a listener question to get to before the rest of the show. This comes from Bert Wenkenbach in the Netherlands. He thanks us for answering his question last week. He says, I know what history tells us when it comes to credit contractions, no doubt about that, but I'm still pondering what the exact mechanism is. Today, whole markets can be absorbed by central banks. Just take a look at the Japanese or European bond markets. Is that what central banks can't absorb, that these markets sell and panic? Is there too much leverage in the system that can cause a cascade of bankruptcies?
Wow, a cascade of bankruptcies, Bert. That's a good conclusion to an interesting question. Yeah, it's not the first time the world has faced a credit contraction. And the setup to a credit contraction, of course, has always been a huge expansion of credit done in a speculative mania. I mean, nobody's going to ever pay off any of this debt when they take it on. And because there have been a number of previous examples, actually during the week I came up with a line that prior to 1929, there were 4 1929s, going back to the first bubble in 1720. So they happen, and more debt is issued than can be serviced by an economy, even if it's flat. But the problem is that once the financial bubble is over, and because the financial activity is such a large portion of overall the economy, when the markets head south, so does the economy, which has happened. Now, it's had the confusion of being driven worse by the Wuhan flu, but nonetheless, you have to face what's happening here. So, actually, history suggests that the bailout, which is immense, won't work. In 1929, the head of the New York Fed bought bonds out of the market, and he exceeded his authority by a factor of 6 times. And then in 1932, in July, which was ironically at that bottom of that bear market, there was an editorial at Barron's pointing out that every anti-deflationary measure taken by the Fed is seen not to be working. And the anti-deflationary measure was buying bonds out of the market. And then also at that period, both in The Economist and Barron's, I made notes out of each weekly publication. And then there was a 2-week period in that July where the bond selling seemed to stop, and there was a bit of a gap, and then all of a sudden the market realized that all of the selling of bonds, the liquidation, had quit, and boom, up went the stock market. So there is evidence that in previous post-bubble contractions, the central bankers poured money into the markets and you still went into a lengthy contraction. And this is what I think is going to happen this time.
Bob, they're pouring billions and trillions of dollars into the markets right now. Is that a waste of money?
Oh, I think it'll eventually be seen. Yes, it's a theory that has never worked. It dates back to 1622 when there was a crash in 1618, and an intellectual by the name of Edward Misselden, in an otherwise sensible paper, pointed out that or his hopes were that if you created credit from somewhere, you could make a credit contraction go away. But a credit contraction is caused by too much credit. So if you create even more, what's it going to do? The other thing is that the belief in central bankers is such that going into December, January, there was no possible probability that anything would go wrong because the Fed was there. And so then this notion that the Fed can prevent bad things from happening removes the concept of risk from the market. And then if everybody's bid for no risk, and then a risk discovery comes along, hey, markets go south. But the markets would have gone down anyways. And what you had here is this coronavirus thing, and too many governments going completely authoritarian on it has trashed the global economy faster than anything has happened in the past. So, but Bert, thanks for your question. I think the intense application of liquidity has been tried before, and it hasn't worked. So we'll watch and see how this goes. Mother Nature will be the impartial adjudicator on this one.
After the last big recession in the U.S. in 2009, they did studies and said it would have been more efficient to just let companies, including banks and car makers, just go bankrupt, because we would still have banks afterwards, we would still have cars, but we would have saved billions of dollars.
Oh, that's right. You end up with the assets in the hands of those who are competent enough to operate them. So bailouts should never be done. Let the markets sort that out, and the markets will, and always have been before governments and academic economists became so ambitious. So, but I think we can get away. I think we're in the early stages of a political reform where every institution is looked at, and if it's hopeless or too authoritarian or just there, it will be reduced or bypassed. So I guess I'm one of the few optimists on the street, not about the financial markets, but about the political world. This latest step by governments to control life down to the nth degree is building a reaction against it. So the next year is going to be very interesting.
We'll have more with Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, the head of the U.S. Fed, said he couldn't foresee negative interest rates in North America. Does he have a say in it?
No. It's market forces, and the drive to negative interest rates in Europe was not intentionally, it wasn't intentional to get them to negative, but it ended up being negative because the theory is that if a central bank issues credit, it immediately prompts business activity and expands the economy. But that's a very naive, primitive syllogism where you confuse correlation with causation. But they still apply this theory that if they give extra credit, it will make the economy go. And that's not the case. So then what happens then with all the credit they were pushing? And the public decided what would be speculated in. And it turns out it was speculated in bonds and in stocks, financial assets. And this then is also going to be the main conditioner, is that the public chooses what will be speculated in. In the 1970s, it was in inflation and in commodities and in gold and silver. And that's where all the gold bugs learned the pattern, and that just lasted for a decade. Then you also had another decade to 2011 when it worked. But you also have to contend with reality out there, and one of the realities is that where the Fed will continue to expand credit, it doesn't go to the economy, it goes to financial speculation. And financial speculation into December, January, ran to excesses, which we had noted on our charts. So it was vulnerable to a decline. And it was also, I guess, in early January when I wrote that, well, technically there is going to be a decline. One doesn't know the reason for the decline ahead of time. And I also wrote then that the media would come up with the explanation after it went down. And of course, what it was the Wuhan flu, which made things even more drastic. So the pattern that we should be respecting is that you have a decade of inflation in tangible assets and commodities. That ended in 2011, and then about 9 years later, like 2020, you have then a great financial mania can complete, and perhaps it did with the January highs. So it's commodity boom, crash. Stock and bond boom, crash. This has been a crash. Then you get the long contraction. So the pattern is set up that then now expects a long contraction to occur. So on our work in early March, no, it was actually March. Yeah, in the middle of March was that we were very close to a bottom. I think the low was in March 23rd, and that things could be favorable into the June period. And that, Jim, is an old seasonality that you can rely on. Where it gives you confidence to work on it is when you have the oversold, and then you look for the overbought. Now we're overbought, and what's the old saying? Sell in May and go away. Well, markets being what they are, sometimes financially speaking, the month of May can have 6 or 8 weeks in it. So whether the high is actually clocked in May or in June doesn't matter. It's the old seasonal thing whereby, like, I looked it up, and the return on investment, for, I don't know, calculated over 60 years or something like that, on the May to October period is like plus 0.3%. And the return on investment from just blindly buying in November and selling in April is like plus 7.5%. So there's the statistics. And then what you have now is that the market is becoming overbought in the window when one could expect to become overbought. So we'll be able to plot out the top on this. Our technical work has been reliable at important lows and been reliable at important highs.
So is this another year where sell in May and go away would work out?
I think it's going to work. Yep. Now, positive things over the next 5 or 6 weeks would be, of course, in many economies around the world, people going back to work. This is beginning to change. The extreme and dire threats from governments about the flu have ran their course, destroyed the economy. But there will be positive things coming as people go back to work. But then what you want to do is watch the technical features of the financial markets and let them guide you rather than what your intuition is saying. So, yeah, the market is up when it should be, and it is showing signs of excess. So, which is what we said in early January. The market was up when it should be. We were looking for a January high, and so now we're looking for another high in using. Now, this was not just stocks, because while the stock market in a financial mania gets most of the attention, there's huge speculation going on in the credit markets. Absolutely insane stuff. So this is where one has to look at not just the stock market, but you have to look at the credit markets as well, yield spreads, the yield curve. You have to look at industrial commodities. All of this, you just can't analyze the financial markets by looking at companies, choosing the best management, and assuming they'll be able to ride out any problem. And then the other standard in investment management is that the Fed is going to be at my 6 o'clock. So then that means fund managers can remain long for longer than they should, because they really believe that the Federal Reserve is taking away the downside. There's no risk. So, but we're discovering risk now, and probably discover more risk in the fall.
And Bob, it's not just the financial markets that have these up and down cycles, and where people, you have to have that Apple stock or you're nobody. Remember Cabbage Patch dolls,
yes.
Beanie Babies, when sports card mania, where it was $1,000 to get a Bobby Orr rookie card, or even those icicle Christmas lights.
Yeah. I remember telling my daughter, I think she was 12, with Cabbage Patch dolls. I said, Sarah, don't ever forget that one, because it's a proxy for all speculative urges. And Sarah's 45 now. We still talk about Cabbage Patch dolls. And we're talking about the financial markets. And Sarah will say, hey, Dad, I think we got Cabbage Patch dolls here.
We'll have more with Bob Hoye right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration, with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, a headline that caught your eye. Wall Street bonuses set to fall by at least 30% this year. Really? There will be bonuses this year?
Well, your quip is a good one. Yeah, we all know that the Wall Street bonuses are calculated as you get towards the end of the year in December, and then at the Christmas period you get all the staff get their Christmas bonuses, and it's many cases it can be even 1 or 2 times what your salary may be. So you don't have to be a high-producing salesman in order to make a big buck going into Christmas. So obviously they're getting the story out ahead of time that there just won't be the commissions and fees in the business that there has been, and that, hey, watch out when Christmas comes. And I believe that'll be the case, perhaps even more so, because maybe there could be some weakness in the financial markets into later in the year.
Well, Neiman Marcus, Macy's, all filing for bankruptcy protection. I'm just wondering, will there be a Macy's Thanksgiving parade in New York this year?
Ooh. Yeah, I hadn't thought that far ahead. Who knows? Of course, the big, what do they call them, brick and mortar stores and department stores have been a dying feature anyways, as you've got the internet trade come in. And so this is, it's sad to see these things going, but then, as Schumpeter said, capitalism is creative destruction. When something's not needed anymore, it goes. And obviously, department stores and big box stores and malls are not needed as much as they were, and they're changing, and market forces can be quite implacable. But you go the other way, and say late 1800s, when Sears Roebuck started with their catalogs, and the merchandise and the catalogs were fabulous, and you were in a farm, say in rural Iowa somewhere, and even at your nearest town, you wouldn't have any of that merchandise. So then people ordered it, and perhaps merchants in nearby towns didn't do so well. So, and then, of course, in the 70s and 80s, along came Walmart, which destroyed Main Street. And then now you've got Internet, Amazon stuff destroying Mall Street. So it's fascinating being an economic. Actually, Jim, I'd sooner say I'm a market historian rather than economic historian, because economics has always just been the history of ideas rather than the history of market reality. So it's sad to see giants like Macy's or Neiman Marcus going, but that is the market, and if perhaps we can get the similar reduction in the promotion of the government as a provider of goods and services, now that would be very good too.
And in Western Canada, where Army and Navy stores won't be opening again. And remember the near riotous shoe sales they used to have every spring.
Oh, yeah. Yeah, I saw that news go by the other day. Army and Navy, an important business outlets in the big store downtown. And I guess it kept the Cohen family in comfort for for a couple of generations. But it's all over now. So then what happens to the big store downtown? Hey, becomes real estate, and something will be developed there. And this is then market forces determining a new economic valuation for a bit of property. So it's fascinating to watch, Jim.
People are speculating what's going to happen to all of these mega shopping malls, because without the anchor stores, the little stores in them can't support that structure.
Oh yeah, no, this is a changing thing, and as I said, perhaps the same market forces could work over the long socialist running idea of the state providing goods and services. I'm going to write a piece on that. Thanks for stimulating that idea. But also, Jim, at the moment, your standard gold bug is looking at what the Fed's talking about, what the Fed's been doing, and then this is into a world they understand. Oh, we're going to get inflation, and commodities are going to go to the moon, and gold is going to be great, and silver is going to be great. But this is not the case. It's the turn for deflation. You had your turn for inflation in tangible assets. Then since 2009, that crash ended, and it was the turn for inflation in financial assets. And we know that at the end of that, each inflation in financial assets ends with a climax. For the stock market, it could have been January, and then it goes into a contraction. So I've used the term a post-bubble contraction, whereby the incredible bubble in credit instruments deflates. And one of the other things in history has been that in a post-bubble contraction, the senior currency becomes chronically strong against most commodities and most currencies, and as I like to show in most of the time. And that is due, the best explanation I could come up with it is that on the financial bubble, most of the debt is written in the financial center, which of late has been New York, and written in the world senior currency, which of late is the U.S. dollar. So all of that debt that has to be serviced in dollars into New York then is a huge short position in dollars. So this is where, quite likely, the U.S. dollar will be chronically firm and industrial commodities chronically weak, and the gold sector, and I'll continue the theme, chronically strong. You've had your best bull markets for gold in the post-bubble deflations. The 1930s was incredible for the gold sector. Same with the 1840s. As a matter of fact, the biggest gold rushes have occurred close to the low on a major contraction when you've had a decade of high unemployment and you've had a decade of high real prices for gold. So everybody goes looking for it. And you can have, as I say, I got a list. Everybody wants to find out about it. Just let me know. A list of the great gold rushes. 1895, depression bottom. Mid-1840s, depression bottom. So it's all there in history.
Bob, thank you so much.
Well, we look forward to next week, and we look forward to, I'm going to work on the theme where the big box stores are contracting. The concept of a government as a big box store providing goods and services could also contract. Yep, Jim, you gave me a good theme.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HoweStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.